Passive investors should follow 4 rules. And if they do, they're probably going to be okay. They need to make sure they invest with somebody with experience for obvious reasons, right? Because we didn't know hyperinflation was coming. We didn't know COVID was coming. So you got to have an experienced management team. You got to have a track record of just not buying deals, but selling them and proving you can make money. You got to have a firm that's transparent, right? Our entire track record's on our website, for example, and vetted by a third-party firm, blah, blah, blah. Transparency is really important. And then they got to put investors first.
Welcome to the Peak Profits Podcast, your guide to maximizing returns in passive real estate investing. Hosted by Brian Morris and Chris Ward of 7 Peak Capital, we dive into conversations with industry experts, sharing insights, strategies, and stories to elevate your investment portfolio. Whether you're a seasoned investor or just starting out, this podcast is designed to give you the edge for financial freedom. Get ready to unlock new opportunities, discover the secrets of successful investing, and take your passive real estate investments to the next level. Now, let's go reach those peak profits together.
Hello and welcome back to Peak Profits. Today we are joined by Ken G. Ken is the founder and managing member of KRI Partners, a real estate, private equity and investor education firm. Ken has more than 26 years of real estate, banking, private equity and real estate investing experience. Throughout his career, Ken has been involved in transactions valued at more than $2 billion, which has included acquisition, managing, and financing a various number of multifamily real estate projects. Ken, it's great to have you with us today. How are you? We'd love to have you just quickly introduce yourself, and then we can jump right in.
Yeah. So first of all, thank you for having me. I'm thrilled to be here. I'm really looking forward to this. As you said, I'm the managing member here at KRI. Started the company about 27 years ago. And all we do is multifamily. And I think you already alluded, our company's based on 2 things. One, helping people do what we do. That's the investor education side. And the other side of our business is helping people make money doing what we do. And that is through the passive investment. So in our world, if you're interested in making money in real estate, in multifamily, we're here for you, no matter what side you go to.
That's awesome. 26 years is impressive, to say the least, to have that firm. So take us back to starting that firm. You came from, I believe, Deloitte, and you have a background in finance,
I do.
CPA with Deloitte, and you were in their tax and M&A practice. So can you take us back to that time with Deloitte and then your transition to starting KRI?
Yeah. So, you know what? I skipped over the whole background. I grew up in Toledo, Ohio, got my undergrad from the University of Toledo, moved to Cleveland, and became a commercial lender for 5 years. And that was good experience. All my clients wanted to talk to their CPAs, though, for all their advice. I thought, man, I can help you. They're like, no, we'll talk to our CPA. I'm like, well, that's annoying. All right. So I went to school at night, Case Western Reserve, and became a CPA. That's how I got to Deloitte, thinking, cool, now everybody will actually want to talk to me. Spent 7 years at Deloitte on the tax. I did a ton of M&A work, due diligence, some compliance, just all kind of, the cool stuff that you can do. M&A work is really cool when you're in the CPA chair. But it was there that everything changed for me because my family was just started back then. So I would do my daughter's feeding in the middle of the night, right? Because I was working at Deloitte and CPAs work a lot. So the best I could do with her was like 3 a.m. I did her 3 a.m. feeding so my wife could sleep. And it was cool until I realized it wasn't cool because it was 3 o'clock in the morning and it's the time that I'm spending with my daughter. I'm like, dude, you really screwed this up, right? I thought I did everything right. I mean, I had a good job at Deloitte. I felt like I was being successful. I got good grades. I got a good job. I did everything I was supposed to do. And now I just realized that my family's going to grow up without me because I'm going to be working way too much and have no control over my schedule. And that's what actually was my catalyst to get into multifamily. I'd already had a ton of clients at the bank that were in real estate, so I knew they made a lot of money. At Deloitte, it had a massive real estate practice. Like if I told you who our clients were, you would know them. They're household names. And I'm like surrounded by people making money in real estate, and they had a very different life than I did. So that's when I said, I got to figure this out. And that's what I did. I went and spent about a year and a half just going to apartment association meetings and anything I could do to learn from somebody. back then there were no podcasts. The KRI education side of our business, none of that stuff existed. The only person out there doing anything in real estate was like Carlton Sheets. You probably don't even know that name, but he was an old single family guy, and I bought his program, and that was the only thing out there. So what I did was I did a lot of networking at these apartment association meetings, usually with the person who was lecturing, because I figured they're up at the front of the room and they must know something. Learned as much as I could, bought 3 deals back in 1997, 1998, sold them 3 years later, made $500,000. And then I said, wow, are you serious? I just made $500,000 on the side. Like, that was just ridiculous to me to even think that could ever happen. I mean, just flat out ridiculous, but it did happen. And then I continued. I ended up staying at Deloitte another year or so, maybe a year and a half, because I'm chicken. I want to make sure I don't do something stupid. And now all I do is real estate. So I know that was a long-winded story there, but everybody has a weird story about how they end up where they are, and that's.
Yeah, I think you're absolutely right that everyone does almost have their own little journey into it, and it's always nice to hear that you recognize fairly quickly that your role of kind of being with your kids and just doing the feedings at 3 a.m. number one wasn't sustainable, and also probably not what you wanted the upbringing of your children to be from your perspective, right? As you mentioned, as you wanted to be really more engaged and more part of their lives instead of just doing kind of the 3 a.m. Feedings.
Yeah. No, it made me sick to think they were going to grow up without me. I mean, that really made me sick, because that's not why you're a dad.
Exactly. And Ken, you actually have almost, although you said there weren't really any podcasts available at the time, you did still almost enroll yourself, quote unquote, into almost like a mastermind, or you looked for mentors as part of your growth journey and really your education journey. Number one, how did you ultimately leverage that mentorship program, the single family one that you leveraged, and apply that into the multifamily market? Because I think there's one of the key things that you say is that you've gone all in on multifamily. So we'll kind of unpick what going all in on multifamily means, but we'd love to just hear your education journey bringing you to the point where you said, you know what, I'm going all in on multifamily, and you made $500,000 as a side hustle, which is obviously incredible.
Yeah, it is ridiculous. So I think back, I knew I wanted to get into real estate. So I bought the Carlton Sheets thing. And if you don't, it's his no down payment program, right? Where you buy a single family home, and he did a nice job with this program, walking you through it. But I couldn't figure out, like, wait a minute. So I'm going to do this and make a net $50 a month or $100 a month. And I'm like, man, that doesn't seem like a lot of money, right? I couldn't figure out and get comfortable with, wait a minute, if a roof goes bad, I'm toast. Like, maybe I eked out $100 a month for 2 years, 3 years. There's a roof. There goes all my money. I'm like, well, that didn't work out so well. So that's kind of the way I was thinking about single families. The other thing that bugged me, remember, I was at Deloitte at the time. So the fact that I was actually going to be able to have time to go do anything on site. I mean, I was already working 80 hours a week. There's no way. So I thought, I got to have something big enough that I can afford to pay people to do this stuff on site. First of all, I couldn't change a faucet to save my life, right? That is not what I knew how to do. So I had my maintenance guy once made fun of me. I said, oh, let me do this kitchen floor. Remember the 12-inch self-stick tiles? Remember? The little stuff, you peel it off, you stick it on. It isn't that hard, right?
Yeah.
8 hours later, I'm working on this kitchen floor. He's like, what the hell are you doing? I said, well, I have to knock this out. He's like, are you serious? He's like, I'd have been done in an hour and a half. I said, then it's yours. Right. But here's the point. The point was, I needed to have people on site. I needed enough money in the thing that I could run it like a business. So that's when I realized I need to be a multifamily, because I can't, right? If I take more time out of my life and go fix something or try to, or turn a unit, if on a duplex, I just couldn't imagine that happening. And I didn't figure out it could make money. And I thought, you know what, the multifamily seems to make sense. So now, how did I leverage the people at these apartment association meetings? I mean, you say it's mastermind. That's probably, it's fair to say, probably a gross overstatement, right? I mean, these guys, they lectured on evictions. They lectured on screening tenants. They lectured on, I don't know, just taxes, just stupid things, right? Operationally, because that's what apartment association meetings are really focused on, is operating an apartment complex, not buying, analyzing, financing, none of that stuff, right? So, my first deal, I actually paid an attorney. This is how nervous I was. So I had done a lot of learning. I was a CPA. I should know numbers. I should get most of that. But I hired this attorney, paid him $3,000. I met him at one of those. He was a lecturer. His name was Howard. I won't use his last name, but he owned 4,000 units. And I thought, well, this is good because he could be my attorney, right? He's a practicing attorney and he knows apartments. Like, he could bless my deal for me. And so I hired him to do just that, because you're nervous when you first do this. You're like, man, how do I know I'm not getting set up by the seller? How do I know I'm just not going to be sorry I did this and lose everything that I've worked for? And I hired him. $3,000 back then was a lot of money. And so I did that, and it was the right thing to do, because he looked at the deal and he's like, Ken, you're going to make $100,000 on this in 5 years. I said, oh my God, are you serious? He's like, yeah. He knew the seller. Everybody knows everybody in every business, right? And he knew the seller. He's a good guy, blah, blah, blah. So that's kind of how I would leverage it, right? I met the eviction guy that spoke about evictions. He was also an attorney. He did a lot of evictions. Well, over time, this was a period of years that it took me to develop this relationship, but we ended up being partners. And we did a whole bunch of deals together. His name's Gary. Super amazing guy. He gave me that break, right? He gave me that person that understood, had more net worth than me, had more liquidity than me, right? So what I did was, I had all these problems in the beginning. I didn't have any money. I didn't have a clue. I didn't have a lot of things. And I just tried to solve them individually. Now, I would like to say, thinking back, that I was that structured when I was doing it. I probably wasn't, but I knew there were hurdles, right? Every time I found a hurdle, I'm like, shit, I got to figure this out. How do I get over this hurdle? And then I figured out how to get over it and just went on with it. So that's the way I leveraged those apartment association meetings. It wasn't the easiest way to do it. Now, I mean, we've structured our education. I'm not here to promote our education, but we structured our entire program to give them what they need when they need it. Like, oh my gosh, if I had that back then, it would have accelerated me years, because I had to figure every little thing out. First of all, I had to find out that I had a problem. Then I had to figure out how to solve it.
Yeah, that's awesome. And I think when you speak about a lot of that, when you're first getting into an industry of any kind, right, it starts with education and then trying to understand kind of learning and who to network with. And you mentioned, like, you're nervous, right? You're scared getting into it, right, to make that first jump.
You bet.
But you've obviously been doing it now for 25 plus years, 26 years, and obviously you've had a lot of success. And I can only imagine, if you look back on the late 90s versus what you know today, how much differently you can look at things, or leverage your experience, or even laugh about, right, some of those early year deals. So that brings one thing to my head, and real estate is so much about the cycles, right? So if you've been doing it for this long, you've been through a good amount of cycles and understanding. Right, the housing crash of 07, 08, 09, those couple years that were very difficult, and then multifamily, from after that to 2020 was on an absolute tear, right? And then things were peaking in 21, 22. People were paying super high valuations, and now we're actually at a little bit of a different point, right, with interest rates skyrocketing over the last 24 to 36 months. So just love to get your perspective on that, being through cycles for over 25 years. What do you see today, and like what have you kind of taken away from what you've been through?
Yeah, so every time, it's like anything in business, right? When you experience something, you learn something from it, and hopefully you apply it going forward. So massive lessons were learned in 08, 09 for me. First of all, we owned properties back then. We managed a couple thousand units. We watched people dropping left and right around us. We never lost a property. We never lost a dime of our investor money. So I'm really proud of that. I got to watch people fail, and that sucks. And that really sucked at the time. But what it did is it gave you the opportunity to really understand how and why they failed. And it's because they didn't understand how to manage debt. Well, I'm in the real estate business. I need to know how to fix the toilet. No, you don't. This is a capital intensive business. You've got to understand debt, because if you don't, and you're not careful with it, you can over leverage, you can gamble when you shouldn't, all that kind of stuff. So that was the massive lesson that I learned in 08, 09. Fast forward This is the same lessons being applied right now. What are people doing that are in trouble? So they may have overpaid, but more importantly, they didn't protect themselves against interest rates. They didn't set their debt up so that if there was a little hiccup, they would still be okay, right? They thought they would turn the property in 3 years, so they put 3-year debt on it. No, I put 7-year debt on it if I think I'm going to turn it in 3 years, right? Gives me a longer runway. That was the lesson to be learned. And so I continue to apply it. So that's what's happening right now. Although we have a lot of distressed sellers. Now, I thought it was going to happen in 24. It didn't. And it's because the lenders have flexibility now. The type of lenders, those are all bridge lenders. They're different. They're funded differently. They're not governed by Freddie and Fannie and HUD, and the bank regulators aren't crawling down their neck like they did back in 08 and 09 and making people foreclose. Now they can make good business decisions, say, you know what, property's doing okay. The management team's okay. Yeah, rates went up. He's unprotected. So we can foreclose and lose a lot of money or try to work with these people and extend, right? You've heard extend and pretend or pretend and extend. That's what they did. Well, they did that in 24. I'm hearing already that lenders say, guys, I can't keep doing this. You've got to sell this asset. And that's what's happening now. So how did they get into that situation? Because they didn't manage their debt properly. They didn't execute on their business plan. So what it all comes down to, I don't care where you're at in the cycle. If you stay disciplined, you'll be okay. Right? So we want in at close to even leverage, and we need $200 to $300 in upside, not hope and pray upside. It's upside that we believe is there today, so that when we take over that property, we can get that upside rather quickly. Because what solves all problems? More cash flow. Right? So we just need. So now you're seeing discipline, which I learned way back when. And new people just don't have it yet because they didn't have the pain and suffering of 08, 09, right? They didn't go through that hell. So that's the thing now that has always served us well. Our properties all have fixed rate debt. I think the shortest term left is 3 years, 2 to 3 years on fixed rate debt that we set in place a while ago. And it goes out as long as 7 years because I want that runway. And people are like, but you're going to have this prepayment penalty. Well, I'd rather have a little prepay penalty than to be losing it, right? Sorry, Mr. or Mrs. Investor, I just lost all your money. That's not a good conversation to have.
Yeah, absolutely. And to one point I wanted to work off that too is talking about your portfolio and kind of where you guys focus on today. I know your offices are in Cleveland, but you're traveling a lot and you focus primarily on Florida. So what does that portfolio look like today, and how has it changed over the years since you've been managing it?
Yeah. So the first 10 years was in Cleveland because that's where I lived. And that's how probably most people should start off, in their backyard. It's just really hard to make money in Cleveland because it's not, this demand supply thing that everybody talks about, right? Housing demand and supply. It's not in my favor in Cleveland. It's just not. Cleveland's generally losing population and they're not adding new supply, but they're still in Cleveland. The way I got a good tenant was to steal it from the guy next door by offering them a free month. Now, about 15 years ago, I said, man, we've done okay in Cleveland. What if we actually bought in an area? And I actually said this out loud. What if we went to a place where people actually really wanted to live? Like, what do you think would happen there? And 15 years ago, we started that process. Now, the hard part is getting into a market like Florida, because there's a whole lot of people already focused on Florida for the same reasons that I wanted to focus on. So it just takes a really long time to get into that fray, right? To get integrated and known and develop a reputation and show that you're for real. And it just is a really slow process. So, in Florida, we have about 80% of our properties right now are over 95% and moving rents in a market when most people say, oh, rents are flat, right? You're hearing it, I'm sure.
Yep.
Rents are not flat, not where we are, right? Why? Because people want to live there. See, the demand supply thing really, really matters. So we're continuing to move. That's why we're in Florida. Plus, it doesn't suck to get on a plane to fly to Florida in the winter. I'm just telling you. See, that's what other thing about real estate that nobody tells you is you can do it wherever it is you want to be. Well, I wanted to be in Florida. I want to be in nice weather. I like sunshine. And so you just it's a 2-hour plane ride. It's easy to get there. We have direct flights, and I get on a plane at 7. I'm in my office by 9:30 in our Tampa office. So perfect. How can you not do that?
Yeah, and that you're bringing some new perspective, I think, Ken, to what I don't think anyone on the podcast has really kind of mentioned yet. Buying where you also want to be, right? Like going to the sun, whether it's in the sun, right? That's a really interesting perspective as well of how to look at where if your backyard isn't ultimately the perfect place, or you're struggling to find a deal that pencils. For Brian and I in New York, it's just far too, that barrier to
Right.
entry is just far too high.
Mm-hmm.
What other things do you think stops either investors who are looking to invest passively or more active investors from buying that first property or ultimately making that first investment?
Yeah. So let's talk about people who are on the active side. I know for a fact what the problem is because I talk to them every day. They don't have the confidence. So here's what happens. When you really believe you understand something and you're confident in your knowledge and you understand it, you don't hold yourself back because you just know. You're like, no, I understand this. I know how to underwrite. I know what the numbers should be. I know, right? And so what happens is when you don't have that knowledge and you approach the business in a superficial way, you know there's a lot going on underneath that you don't know and don't understand. And most people, they don't want to lose their own money. They don't want to lose anybody's money. So they just don't act. And it's because they don't take the time to actually learn. I'm just telling you, I see it all the time. As soon as we teach people to underwrite, they're like, oh my gosh, the broker can't take advantage of me anymore. I know, because you know the numbers, right?
Yep.
You went and figured it out. Now, what usually stops people from that front is that they don't want to do that work. Right. So I always quote John Maxwell. I heard him a couple years ago. He had a little saying that is just so stuck with me. People want to do what you do, but they don't want to do what you did. See, they don't want to do what I did, and that is dive into the weeds and understand the business and everything else. I implore you to ask any business person who is successful, and they will tell you they're probably successful because they understand the details of their business. It's not because they don't understand it. They're flying at 30,000 feet. They understand it, and it's those details that makes them really, really successful. So I know on the active side. Now, on the passive side, back in 2021, anybody would give you their money for anything because they just thought there's no way that this could go bad. Today, that's different. It actually helps us because we've been around for a long time. We've raised $50 million almost of our own, from investors. So what happens now is those people that just jumped in, you'd be shocked at how uncareful some investors are. I don't know why, but they're not anymore because they're now in deals and they're losing money in those deals. They're like, whoa, what's going on here? So if investors now are afraid to invest, it's because they're not familiar with giving one person like $100,000, right? We have $100,000 minimum. So that's the first thing they have to get over. The second thing they have to get over is, now, how do I trust KRI over someone else? Because I just gave, we talk to investors all the time. Yeah, I'm in 5 deals, and 4 of the 5, I'll probably lose all my money. I'm like, oh my God. And you're still having these conversations with me? Like, wow. See, so now they've been burnt. So I came up with a number of years ago, I've been preaching this for years. Passive investors should follow 4 rules. And if they do, they're probably going to be okay. They need to make sure they invest with somebody with experience for obvious reasons, right? Because we didn't know hyperinflation was coming. We didn't know COVID was coming. So you got to have an experienced management team. You got to have a track record of just not buying deals, but selling them and proving you can make money. You got to have a firm that's transparent. Right. Our entire track record's on our website, for example, and vetted by a third party firm, blah, blah, blah. Transparency is really important. And then they got to put investors first. That's usually the hardest thing for them to figure out. But when I look back and look at all those investors that are losing money, they probably broke 1 or 2 of those rules. And it's almost always because they invested with someone new. And nothing wrong with investing with someone new, but the new person didn't go dive into the details and make sure they knew what they were doing. Does that make sense? So
absolutely.
That's kind of what's going on right now. It's benefiting us because there are fewer people that people are willing to give their money to because we have the experience now, right? All those people who are inexperienced, they can't get deals right now. The brokers won't give them to them. The lenders won't give them the money. And so the investors are going and realizing experience might matter. And so now it's really helping us, but it's making the whole thing, I'm sure it's shrinking the investor pool of money.
Right. I think that's super important. And I think it comes up a lot in these conversations that we have when you're vetting a partner, an operator, or a sponsor who's been in the
Hmm.
industry. One is length of experience in years, but also those full cycle deals. How have your
Hmm.
deals performed, right?
Yep.
A lot of these projection decks and a lot of these deals kind of project the same numbers or can come around,
Yeah.
1.5, 2x equity multiple, 14 to
Yep.
18% IRR. Everything looks great on paper.
Hmm.
But at the end of the day, how are your projections versus your actual
Yeah.
experience and deals going? And I think that's super important for investors and listeners to understand when vetting out operators. In addition to that, how are your communications, right? I think
Hmm.
investors like when they're giving you
Yeah.
$100,000, right, and it's in a private placement, and some partners and people will have portals so they can go in and kind of check what's
Hmm.
going on. But what do
Yep.
those communications look like? Because I think that's an
Yeah.
important aspect of these investments as well.
Yeah, no, you're not wrong. I can't tell you how many times I've heard people say, "Oh yeah, I gave them my money and I haven't heard from them for 6 months." I thought, but it happens. It's real. So we do. First of all, we have a portal, just like probably most bigger firms do. They can always go there, but we do quarterly P&L, rent roll, a balance sheet, and we write up a narrative. What's going on at each one of the properties? What's maybe we're doing a renovation, whatever it is, we're talking about. We're talking about. We also have what we call our Real Deal Investor Update webinar that we put on once a month. If anybody's interested, you just go to our website. It's always on the little green banner, but it's where I'm going through like at ridiculous levels of detail, like how many leasing leads did we get? What's the occupancy? What is our insurance cost? What is our delinquency? Like ridiculous amounts of detail, right? We do that because I want to be transparent. That's really important, right? So our investors have that ability. And then we also give them the ability, first of all, they have my cell phone, right? They have my cell phone.
Yeah.
If they call, I'll answer the phone, right? Or call them right
Yeah,
back. That's
that's
very
important.
unusual.
Yeah.
And they have the ability to tour the asset themselves anytime they want. I mean, they don't have to tell me. Our people are there. It doesn't matter. But usually if you let me know you're coming, I'll make sure that, they carve out the time for them. So that's how I believe communication should be. And it's really important to me that, they want to hear the good, bad, and the ugly. Whatever it is, it is. And let me tell you what's happening, and I'll tell you why, and so on and so forth. So that's what we do. But not everybody does that. You probably know that.
Yeah, and I think it again, that just really starts to build trust with these
Mhm.
investors. And what your ultimate hope, I'm sure, Ken, is that these investors aren't just one-time investors with you.
That's
They're
right.
people that continue to return because you've been able to protect their money, make them money, because as a passive investor, that's ultimately what everybody is looking to do, right? You're not looking
Yep.
to just have your money stay the same. You're ultimately looking to
Yeah.
increase your equity or
Mm-hmm.
your cash flow in various different
Mm-hmm.
ways, right? So that ultimately gives them the trust to continue coming back and
Mm-hmm.
investing ultimately with you. I do want to just go back to when you spoke about some of the kind of business plan and the learning and the underwriting.
Mm-hmm.
Can you tell us a little bit more about what the KRI learning ultimately is, and kind of
Yeah.
talk through what you specialize in there,
Mm-hmm.
Ken?
Yeah. So on the active side, if you want to do what I do, I'm going to show you every single thing that we do. Like there's no daylight between what we do and what we teach in our program. We insist that they start with underwriting because you just have to, right? You have to know how to underwrite. I'm a CPA by background, as you know. You get our spreadsheets, our analyzer, the exact same ones I use when I underwrite my own deals. No different. If I change mine, I change theirs, all that stuff. So first start with underwriting. And then there's a part of our program that nobody wants to focus on, but you have to. The first thing we do is focus on you right after underwriting. Okay, tell me about you. Let's figure out who you are. Let's do your personal financial statement. You get our spreadsheet, right? A CPA might have a good PFS spreadsheet, right? We lay out your bio. What are your strengths and weaknesses? What problems do you need to solve? And then we start to help you figure out what market is right for you. Maybe it's the one in your backyard. Maybe your backyard sucks, right? Maybe you're in your situation where you don't want to buy in your backyard. So let's figure out where it is you want to buy. Because most people, They're looking at deals in Seattle and New York and Boston and Texas. And you can't buy like that. You've got to go find a market or two and just hyper focus on it and really get to know it. So the whole goal here in this first part is to develop a business plan that makes sense for you. And then we help you with the broker talking, right? What's the first thing broker's going to say to you? What are you looking for? And tell me about you. Well, if you haven't had someone like us help you understand that, it's just not going to go well, because brokers, this is not their first rodeo, especially in markets like Florida. They're looking for the guy who wants to buy 200 units, never done a deal before, and has $25 in the bank, right? I mean, they call him all the time because somebody told them that, to go big or go bigger. I don't know what they're told, right? But they are. But the reality of it is they'll never get that deal because the brokers won't give that deal. So once we understand your situation, now we can, with your help, I mean, it's your business plan, not mine, but I want you to actually get a deal, because as soon as you get that first deal, everything changes, because now you're real. Now you're real to the brokers, you're real to the lenders, you're just real, right? People actually will start calling you back. It's really weird what happens. Then we go through the process of how to find the deals. How do you talk to the brokers? How do you tour the deals? How do every little thing that we do. Then how do you get that deal awarded to you? That's part of developing our bio, your bio, not mine, your bio. And then we actually, one of the weird things that we do is kind of happened by accident at first, but we go over your bio inside. We do group coaching calls. If you're in our, what we call our AMA program, you get Tuesdays at noon and Thursdays at noon. So I'm with you. Somebody did the math, 208 hours a year. Like, that's a lot of coaching time. So we bring your bio up and we walk through it on the screen. Well, what's happening? Everybody else in the room, and it's a very high quality room, gets to see, oh my gosh, this guy's got his act together. This is somebody I need to get to know, right? Because most of the time it's really hard for you to be braggadocious about yourself. You don't even realize the cool things you did, and we pull it out of you. Everybody gets to see that, and now you're starting to develop relationships with people who could solve the problems that you have, right? Because you maybe solve their problems. You see what's happening here? Once you get the deal, now we got to teach you how to get it funded. How do you get the debt? How do you get the equity? How do you raise money? Do you even need to raise money? How do you do your due diligence, the financial, right? Every little thing. I call it concept to close. We're literally in the weeds in every step of the way, because, I mean, we've done 19 deals, taken 14 of them full cycle. So we know what that whole process looks like. And we literally, it's like it's not a turnkey business, because you got to spend the time to learn it, but everything you need is right there. And we're with you twice a week for a year. I mean, that's a lot of time to get you up and running. So that's how our system works. And it's been wildly successful. Now if you're in today's situation, Freddie and Fannie, what have they done? What was their solution to the problem? We're not going to give loans to anybody without experience. We're like, oh, well, that sucks. I just got to learn this business and now I can't get a loan. Well, we could be your partner. I'm cool with that, because now you can basically rent my experience. We're careful about that, okay? But we get to spend 208 hours together. We get to know each other really well. And you'll know if we're a match or not. And then we also have an advisor program. We actually have some people who, they don't want to give up any equity. Fine, I'll just advise you on the deal, right? You're still getting that experience on your team. You see, so what we've tried to do is plug every hole. I know what you need. We're just trying to give it to you when you need it. It's really comprehensive.
Yeah, and I think what you've mentioned there a lot is about the whole team, right? Very, very rarely, or if ever at all, especially when you start talking about the 200 kind of unit sizes, this becomes a team effort.
Oh, yeah.
And I think it's really important that you're matching those people with their strengths and weaknesses together as well.
Yep. Yeah. And what it does is it turns the room into just a super high quality room, because now everybody knows what you're good at and what you're not. And that's okay, because, you want to do this. You don't want to do this. You want to do this, and let it fit together. That's the way I believe those partnerships should be formed. I don't like transactional partnerships, and I know you've probably seen them, where, hey, I got this deal. You want to partner with me? What's your name again? Yeah. I analogize it to dating. And all right, forget about the person who met the person, married him the next day. All right, throw them out. But this is like dating. I mean, you got to get to know the other person, and then you decide you're going to do a transaction together. You know what I mean? If they do
Absolutely.
that, those partnerships survive so much more.
Yeah, I think it's important to partner with people that you've done due diligence on, you've built a level of trust with them, credibility, spent time with them. And that's important because partnerships are easy to get into, but if they don't go right, then they're sticky and messy to get out of a lot of
Oh, they're
times. So,
very hard. Yeah.
yeah. So you want to make sure that you're doing the due diligence before legally signing on a partnership with someone, like you said, blindly or blind
Yep.
dating.
It's interesting. We have somebody going through lender due diligence right now, and the lender wants to understand every person in the group. How did you meet each other? How long have you known each other?
Oh,
Have you
wow.
done anything else? You see what's going on here?
Yeah.
Yeah.
What the lenders do, I always analogize. Remember, I used to be a pilot. You probably didn't know that, but I used to be a pilot. I'm still a pilot, but I just don't fly anymore. The FAA, they always referred to it as the tombstone agency, right? Once a plane crashes, they'll figure out why, they'll go fix it so the next plane doesn't crash, right? But it's not until the plane crashes that they fix the problem. Well, lenders kind of do the same thing. Back in 08, 09, if you lived in California, you were happy to buy 20 units in Florida and think that would go well. Well, it doesn't go well. That's ridiculous. So lenders say, we ain't doing that anymore. This time, they're focused on inexperienced people, putting 10 people in a group so they can stack their net worth to get to that $4 million required net worth and liquidity. And they're like, no, this is not working. So they just say no, right? They play whack-a-mole is what they do. And so they fix that problem. So now it's even more important that you have experience on your team. Agreed?
Oh yeah, yeah,
Absolutely.
yeah. It sounds like a recipe for disaster, and it's a little bit reactive rather than being proactive.
They do.
But it's
Kind of
it's
obvious
important.
watching it
Yeah.
happen. Anyway,
Yeah, one thing you mentioned there talking is the 14 full cycle deals, which is impressive, right? Being in business for that long, and as we mentioned earlier on the podcast, was talking about your projections, but actually going full cycle, and clearly you have done that at KRI. So I'd be curious, what is your strategy for 2025 if you feel like this could be a really good year to acquire some good deals, or heading into
Yeah.
2026, kind of where we are with these debt structures and some of these loans coming due and not necessarily allowing them to kick the can down the road anymore. So what is your strategy over the next 2 to 3 years at KRI to get into more deals, and what does that look like?
Yeah, so we used to syndicate. So in the beginning, for about 10 years, we didn't use anybody else's money. It was just our own. Then we started syndicating, right? So you find the deal, then go raise the money. And you know how hard that is to raise a whole bunch of money in a very short time. That's a very harrowing experience. But when you're in a market like Florida and there's 20 or 30 offers on a deal, you got to set yourself apart. So a number of years ago, we said, remember, I was exposed to the private equity world. I said, we need to raise the money first and then go find the deal, because having the money raised is going to make us stronger buyers. So I wasn't wrong. That absolutely has helped us. We now, as of the date we're recording this, we have a little over $17 million in our fund number 4 that's waiting to be deployed. We're looking for deals. And so now, when debt is the problem, which generally it is right now because of the volatility of interest rates and things like that, you just go in at lower leverage. We have the ability to do that because we've raised a bunch of money. So now, what's our strategy for 25? It was the same strategy as 24. It just didn't come to fruition. It's be that strongest buyer. Because if you have already raised the money, and compare me to a syndicator who, yes, they promise they'll raise the money, but they're going to raise as little as they can. You know what I mean? They're going to be more heavily reliant on debt. It's just going to be a different experience than we've already raised the money. We've got enough money to close now. We don't need full leverage. We've been doing this 27 years. We're in and out in our due diligence in a week. Like, you can see what's happening now, right? So we know that when sellers have these problems, they have to close. It's not, well, we'll take a chance with this guy. If it doesn't work out, we'll just go back to the market. They don't have that benefit anymore. So we're now that strong buyer. And that's what we were hoping for in 24. It's just the lenders extended and pretended. So we think the more of those opportunities going to be in 25. Now, I'll tell you, if rates do come down, there's a whole lot more sellers out there, because they're just holding. If they don't have to sell right now, they're not. They're just not. Why would you sell when rates, like in Florida? Why would you sell? The latest asset we bought, it's on our website. It's called the Levi, 100 plus units in St. Pete. We bought it at almost a 6 cap. It's literally a brand new property. Like, that's ridiculous. That should have never happened. Why did it happen? Because we were a strong buyer. We already had the money and they needed to sell, right? There's nothing wrong with them. I mean, the property was fantastic and it continues to do well. So that's our plan for 25. And we're going to continue. We just raising as much money as we can, continue to make, our goal is 20 to 25 million. But, I toured, I don't know when this will air, but I toured several deals last week that I think at least one or two of those will probably end up in our lap, which is what I'm hoping. Because it's been a long dry spell. I will not lie to you. Now, in terms of what we look for, it's always been the same. Close to even leverage, 200 to 300 in upside, right? That in good neighborhoods, growing areas. We don't do crime neighborhoods. We don't do any of that crap anymore. We did it, been there, done that. It's no fun. That's why we don't do it anymore. So that discipline that we've had for many, many years continues. There's no reason to depart from it. We're looking for mid-teens returns, just like you described. 1.8 to 2x over 5 years is what our goal is. Now, if we can get your money out sooner and then you own the asset with no money in it, that's even better. Maybe we'll see. If rates come down, if you think about if rates do come down and we grow income, right, through rent increases, guess what? We're probably going to be able to get a good chunk of their money back, because those are two things that, need to happen. Now, if rates don't come down, that's okay. We're still building in our upside. Does that make sense?
Absolutely. Where would somebody go, Ken, if they were interested in ultimately investing with you into the fund that you just mentioned?
Yeah. So KRIPartners.com. So KRI Partners, PARTNERS.com. And just reach out. I mean, there's 50 million little links that you can get right on our calendar and have a meeting with you. What's important when we do meet with you is we're going to spend time talking about you first, because it's important to me that you're right for what we do, right? Some people come to us and they think they need money in 3 years for their kids' college. Like, that's not good. You can't do that, right? Because I want to sell the asset, but I can't guarantee you I'm going to do that. So a lot of what we do at first is really talking about you, your situation. Does this make sense? Are you cool with it? Do you really understand it? That's really important, because I want these to be long-term relationships, like you'd already said. And most of our investors reinvest. And that's what we want, right? It takes a long time to build up that level of trust. And we just, we want it to pay off for both of us. So that's what's going to happen if you do reach out to us and we have a meeting with you.
We'll make sure to put the links in the notes so you can go directly.
Thank you.
Onto the KRI Partners website. Ken, do you have? Go ahead, Brian.
I think that's important to understand, not only from your perspective, but from the investor's perspective, knowing that these investments are illiquid, right? Knowing that there's a certain hold period, right, that they're in for these investments. And you're not talking about a little bit amount of money, right? You're talking about a good chunk of an investment into each deal. One thing that comes to mind, when you're talking about that, what advice would you give investors that haven't taken the jump yet to invest into multifamily or a passive private placement? We talk to a lot of people weekly that have thought about investing in real estate, have thought about going down this avenue, have considered it. The first one, I think, is always the scariest, because it's new, right? You're handing your money over to an operator that it's just a new investment strategy, right? You can't log into your Fidelity and see kind of where your stock portfolio is on any given time, and you can't sell it, right? So what would you tell to those investors that are thinking about getting in, and why do you feel so bullish about having some type of your portfolio in multifamily?
Yeah. So what should investors do? First of all, I really want them to learn at least something about this business. Warren Buffett tells you always invest in what you understand. He's not wrong. I mean, this is basic stuff, but so many people say, no, I'm leaving it to you. Don't. I want you to understand how we make money in this business. That doesn't mean you need to get to my level of detail, but you got to understand, okay, I'm going to get some cash flow. Okay, what's the relationship to cash flow to value? How does that matter? That you want to understand, right? Because remember, I'm a CPA. I was a lender. Like, this is all I do now. And it's not by accident. It's not because, it's the only thing I have left to do. No, I purposely made this decision. And it's because it can be insanely lucrative for passive investors and people sitting in my chair. And I want you to understand with conviction why. That's really important. So that's the first thing I want investors to do. Just take time and learn. We do so much free stuff that you can go onto our site, and I get a free underwriting webinar. I get a free, how do you buy your first apartment webinar. I got our real deal webinars. I got our workshop, all this free stuff. Avail yourself of all that so that when you come to the table as an investor, you're like, okay, I get this. I understand. Because what people learn when they spend time around us is everybody knows you can make a lot of money in real estate. Everybody does. There's a reason rich people do this. I mean, rich people don't do stuff that loses money. They just don't do that. And so I like it because I can deliver mid-teens, 20, 25, 30% annual returns, right? No guarantees, but I can deliver those kind of returns in a relatively low risk asset, meaning multifamily. Like I can figure out how to make office go away, right? We're dealing with that now. I can figure out how self-storage might go away, although you might not believe it, but people can part with their crap. They can, and that could be a problem, right? Same thing with retail, same thing. But I can't figure out how to make multifamily go away. You see, so when an investor starts to understand why someone like me likes this risk return profile, now you start to really I understand now why rich people do this. Imagine, like, I'll just tell you, our Arbors and Garden Grove deal, we bought it 8 years ago. We were going to hold it 3 to 5 years. Well, we raised $2.2 million to do the deal. Well, since then, we've returned all their money. They got another $1.8 million. They're still in the deal. They still get cash flow. They still have $5 million in equity in it. And we have enough money in the bank to update the whole property because now it's 22 years old and it needs to keep up with the new stuff. So what happened? Those people, not only did they get their money back, they almost got a double. That money is now working on another deal and they still have all this equity. This is how rich people get insanely wealthy. And once people understand that, they're like, I get it now, right? Because you watch as they learn more, what happens? Their conviction goes up because now they understand it. Same thing with people that won't buy their own apartment building because they don't really understand it yet. So that's the first thing I want investors to do. And then secondly, just do homework. Just follow our 4 rules, right? Follow our 4 rules and check sponsors against those 4 rules and see which ones work and which ones don't. And then talk to as many people as you can, like in our Real Deal webinar. I don't know if you know much about Zoom, but Zoom doesn't let us see private chats. So I get our investors to communicate with other people privately through the chat, right? They don't want to call them on the phone. Nobody wants to be bothered with that stuff, but they'll do it in the chat. Now these investors, hey, you've been in Ken's deals? Yeah, I've been in 4 of them. Well, how's it going? What's going on? Blah, blah, blah. So you get that. So you do some real homework on these guys. And then as soon as you learn and you do some homework, the decision actually gets pretty easy, or at least I feel like it does. It might not mean it doesn't mean that you won't be a little bit stressed on your first one. So what I do is if I do feel you're stressed, I'll knock down your investment. I'll say, you know what? You were going to go in at 200. No. Yeah. I go in at 100. I don't want you to lay awake at night I call it investor remorse. Life's way too short for that kind of stress. You can always get in the next deal. See, it's that kind of stuff that's going to matter, right? So that you can get in at a number that makes sense, that doesn't freak you out. If it gets held up longer than you thought it was going to get held up, that kind of stuff. So that's what I want new investors to do. And it kind of seems to make sense, but I mean, it's not like buying a stock, right? And most people buy stocks and they don't really research the companies. At least I don't think they do. And so that's why they don't do so well, right? Take a minute and research this thing because it's going to make you a lot of money if you make good choices.
I can almost guarantee most people when they go in buying a stock are not going through the latest investor reports and decks and really understanding the detail. And it's such a good point that you make, that it's really getting yourself to a point that you are comfortable making that can only be from learning about what it is that you're ultimately investing in. And my story specifically, it took me 18 months before I did my own first passive investment as I was going through and I was educating myself. But it had been years and years of figuring out potentially getting a single family and being more of an active investor, right? So it wasn't just an overnight thing, but I think you really educating yourself beforehand goes such a long way. And it does remove some of the hesitation or anxiety that maybe comes with wiring such large lump sums of money. I don't think that ever completely goes away.
Probably.
So, but it definitely does get easier. Ken, is there any final advice you would give to investors before we wrap this up?
Yeah. So investors, go back to my 4 rules. It almost always saves you. Almost always. It's rare that I see somebody not doing well with their investment and they followed all 4 rules. It's not foolproof. I just came up because I've just done empirical evidence. So follow those 4 rules. do some homework, reach out, talk to a lot of people. Our business is not that complicated. It's really not. It doesn't even take them long to figure it out. But once you do and look at people's track record, you're like, okay, this is for real. That's what I want people to do. Just get informed, because I don't want you losing money. The life's way. That's why we got in the education side of our business, because, those same investors that would have invested with us, well, if they invested with somebody and lost money, guess what? They're probably not coming back. So we actually lose as well. So that's it. Take a minute, figure the business out. It's not hard, and just talk to a lot of people, and hopefully we're one of those people.
Yeah, great advice. Those 4 rules and the framework we'll put in the show notes. And I was excited to hear that too, because while Chris and I have been doing our due diligence and our education over the last several years in this industry, it's always nice to hear someone come on and share a little bit of new advice and kind of reiterate what we've heard, but also give us a lens of perspective with someone who's been in the industry for 26 plus years. So thank you again, Ken, for coming on the podcast today. I feel, Chris and I, that you gave us so much great information to share, and we're excited to put this podcast out there to everyone. And we'll share all your information in the show notes as well, so people can find you and reach out as well.
Well, thank you. I've enjoyed it. Hopefully I've helped some of your listeners. That would make me feel good, because that's our mission now, is to help people do what we've been able to do. So thank you again for having me.
Thank you very much, Ken.
Thanks, Ken.
Thank you for tuning in to the Peak Profits Podcast. We hope today's episode was not only inspiring, but packed with actionable insights for your passive real estate investments. Subscribe so you never miss an episode. And if you enjoyed the show, please leave us a review. Your feedback fuels our passion to bring you even more valuable content. Stay connected with us on social media and visit 7peakcapital.com for exclusive resources and updates. Until next time, keep striving towards your financial goals, and let's reach new peaks together.